was one econ that came out this morning. Interestingly enough, it actually came in a little bit better than expectations. But this PMI Purchasing Managers Index, theoretically, the way this thing goes is a reading above 50 means economic expansion, and a reading below 50 means economic contraction. So it's interesting how heading into that sickness window there in early 2000, the economy was actually contracting. And, Brian sort of talk about cycles, and 17, 18 was supposed to be the fear cycle peak. I think you can see that cycle pivot through the end of 17, beginning of 18. And the market was basically doing what it was supposed to do through this period. Recessions usually happen in 8s, 9s, 0s, 1s, and 2s. Then we had this crazy sickness environment that just sent the whole damn world into just utter stupidity, including completely destroying the value and purchasing power of our currency. Point of the matter here, not a lot of econs today. PMI, though, like we said, came in 44.9, slightly higher than expected. Of course, that last reading was often an extreme low. Then the question ultimately here is, did we get a little bit of an uptick because energy prices were a bit friendlier? Did we get a little bit of an uptick because we're heading into the Christmas season, which, something like 70, 80% of all retail sales are done through this window? And what are we going to see? Of course, the beginning of the new year. How can you tell there's a recession? Well, we can take a look at the yield curve. When short rates are higher than long rates, you have a downward sloping curve. This basically implies that the financial services industry is guaranteed to lose money. If the financial services industry, and that's including banks, insurance companies, reinsurance companies, life insurance companies, all those different types of insurance companies, when they're guaranteed to lose money, usually it means that they do less financings, less investment, less, IPOs in the stock market. So capital is constrained, and as a result, their earning streams are constrained, which usually means that they lay off employees because they're not making as much money, and it basically engineers a recession. So as you can clearly see, and if you go to a site like stockcharts.com, they make it really easy for you to see. If you click on their dynamic yield curve, which I think this says yield curve, you can clearly see that the short end of the curve, the rates are higher than the long end of the curve. And they even give you a nice little inverted warning. And as we look back over time, we can see at the top of the dot-com boom, this was Alan Greenspan famously warned the public, hey, you better be careful, irrational exuberance, all that kind of talk. And this is the coming market cycle. Boom, down we go, recession. George Bush Jr.'s days are, inverted yield curve, top of the market, recession's coming up, and boom, down goes the stock market. So here we are, right up at the top of the market. You can see how slowly the curve actually was very normal and healthy as we were working our way up. But as we're rolling over and those short rates have cranked up, now you can see short rates are materially higher than long rates. So odds are we're going to have a recession. And it turns out that actually this is one of the most accurate indicators of recession prediction out there. So very, very accurate.